Okay, good afternoon, everyone. Thank you for taking time out of your schedules. You're busy, I know, busy schedules to join us for the presentation or the webinar today. I'm joined obviously by Marcel, who's going to be taking us through the pre and post retirement products and taking us through some of the nitty-gritties of it and just giving you a little bit more information on how to actually go about using it. And just a little bit of house rules. If you can keep your videos, I see everyone's videos are off, and if you can just keep your mic muted. We won't be doing questions today, but if there's anything specific that you need to ask that relates to the presentation, you're welcome to email Marcel. And sorry, I forgot to introduce myself. I'm Shuaib from Allen Gray. And if there's anything that we have at Allen Gray and you want a little bit more information on, or if there's something you want to ask me directly, you can email her and she'll pass your email on to me to get a little bit more information. But once again, thanks for joining us, and I will hand over to Marcel. Thanks, Marcel.
Good afternoon, everyone. Thanks very much for joining. Sorry, I can't see who I'm looking at, but yeah, it's very strange for me, this online world. I'm much better face to face. So I'll see how I go. I just thought what we should do today is go a little bit more in depth into what Schwab presented the last time. So he touched on the basics of investing the last presentation. So today I'm going to go into the specific details of each product. Obviously there's not enough time to cover them all, and there's not enough time to cover all the aspects of each product, but I thought what I could do is give you an idea of a couple of the distinct advantages and disadvantages, the pros and the cons, the highlighting features of the various investment products, both pre and post retirement. So the first slide, I thought I could just start off at the bottom here. So the journey starts in an investment perspective, if you could call it that. So you need to have a mix of a couple of different investments in your portfolio. So in terms of a short-term investment option, what's available on the market to facilitate your slush fund. So the reason for a slush fund is predominantly for the emergency situations. We've just come through one, I think, which was a good lesson to most, that most people don't have enough saved or put away to look after themselves for not even a month, let alone 6 months of lockdown. I mean, a lot of my clients have had salary reductions, a lot of them have been retrenched, and unfortunately, luckily some have had a slush fund that they could dip into, but others unfortunately have not, and therefore it becomes quite a catastrophe if you start losing your life insurance policy, your short-term insurance and your medical aid, etc., because you can't afford to pay those premiums. So the vehicles that we've got there are things like a bank. You could put some money in a fixed deposit or a money market account linked to your account. The other option there is either a unit trust or a LISP investment. The fundamental difference between a unit trust and a LISP investment, a unit trust is with one company, for example, Allen Gray, and you would invest in an Allen Gray portfolio. A LISP investment, you invest in a platform and you choose that platform, be it Allen Gray or Stanlib or Investec, and then you invest in underlying managers. You can invest across the board. So you can invest in Coronation, Ned Group, etc. But the underlying factors or the underlying portfolio is still a unit trust portfolio. So those would be sort of, and I like a unit trust for a slush fund for the majority of people, purely because it's out of sight, out of mind. So that money, you forget about it. Once you've got enough in there, obviously you can't put it all in at once, I wouldn't imagine. But you obviously have to save for a while to build it up to that 3 to 6 months salary. And then from then on, should you dip into it, you would obviously just need to top it up. Okay. That's sort of a 1 year term. We're looking at then moving up to the medium term products that are available, and that's anything from 2 to 5 years plus. So you've got things like an endowment. You've got, I've put a linked endowment in there because I've got a very specific endowment that I like to recommend to my clients for a very specific reason, and I'll get to that later. The second one is a participation bond, which is very similar to the fixed deposit with a bank, except this one has an underlying property backing. and it's a 5-year term product. The third is the guaranteed investments, and you can have an income or no income with that. In other words, you can reinvest the growth or you can draw the growth out. Moving a bit further along into the long-term space, and all of this that I'm discussing so far is the voluntary space. In other words, this is after-tax money. This is you choosing to invest. You're not forced to invest. The last one, and I think it's probably my favorite of the lot, is the tax-free savings. And I like to try and explain it to my clients that this is your retirement add-on, if I could call it that. So the tax-free savings must be viewed in your mind as a long-term investment. It mustn't be something and move down to the short-term space where you think, okay, well, something's happened, I've had a bit of a problem, I need to access some cash. Because once you've taken it out, you can't put it back. So if you can view the tax-free savings as a long-term investment to top up your retirement, that would be ideal. We then move into the compulsory space, which when I say compulsory, it's just because you've got no choice, I should say, but it's not really true. But that's things like retirement annuities, preservation funds, and pension and provident funds. And that basically you're saving from now up until retirement. And retirement minimum age is 55. A lot of the employer funds are much older than that. They have a 60 or a 65 retirement age. But the earliest you can retire from any retirement product, any of those 3 products, is 55 years old. We then go, if you move on, the next slide will go into the retirement space. So this is all what you're doing before you get to retirement. In other words, it's the various vehicles that are available to you prior to the day that you physically want to retire. And when I say retire, it's also, I think, misunderstood by quite a few people. Retire from a retirement annuity and retire from your profession or your job are also 2 different things. They don't have to happen simultaneously. You can do one without the other and vice versa. So I put in there that you can retire from 55 years old and onwards. So in other words, you may choose to retire. There used to be a maximum of 70. That was taken away. And that actually just proves that we're having to work longer and longer. So this is in the post-retirement phase of your life. A lot of my clients are working much older than retirement age. So, for example, they worked for a corporate. They were asked very nicely to leave at 65. They commuted their pension or provident funds and continued to work, whether it be on a consulting level or on a contract basis, but they continuing to work. So, the fallacy of retirement, I think, has changed dramatically in the environment that we are living in the world that we live in. So, as I said, what you just need to bear in mind is that when you're retiring from a retirement product, it doesn't mean that you're retiring from your occupation or your job. Okay. So again, here we've got 2 different spaces. We've got the voluntary space and the compulsory space. On the voluntary space, you can carry on contributing towards things like your tax-free savings if you haven't already contributed the maximum lifetime limit, which is currently 500,000. You probably would have some matured endowments that need to be, could be utilized as tax-free income. Other voluntary savings vehicles that you would have are part bonds. Again, the one I mentioned previously. That maybe up until now you've used it to reinvest the growth. Now perhaps you need to actually start drawing the interest out of that. You've got the guaranteed investments. Again, you can perhaps now, they may have come to term and you can then reinvest them to start drawing an income. But these are all money that you have voluntarily put in. It's come from after-tax money. The voluntary annuities as well. So you can voluntarily buy an annuity for life. Okay, and I'll go into those in a little bit more detail as well, that give you an income for life. And they've been very taboo in the past, purely because people have wanted a lot of flexibility. But I think in hindsight, most people are kicking themselves. They didn't do at least a part of it into a voluntary annuity to give them that certainty because of the guarantees. Then you can move into the compulsory space. So when you retire off those retirement products that I've mentioned, which is the RA, the preservers, and the pension or the provident fund from your employer, you can have basically have 2 options. One, you can go into it's either called a living or a linked life annuity. It just depends on the service provider that you're using. Okay, and that's a much more flexible income option. And the second of those options would be a little bit less flexible. So, and that's a guaranteed life annuity. They've got lots of names, and as I said, unfortunately, the flavor that has been, or the product that's been sold the most in the last probably 20 or 30 years is the living or linked life annuity, purely because of the fact that you as the client have got a little bit more choice, in terms of what you can do annually and the percentage that you can draw, which unfortunately hasn't boded well in the past 5 or 6 years, because markets have been so poor in terms of their performance. And as I said, people are kicking themselves a little bit. The nice thing is that they've also come up with a hybrid option, a couple of the service providers. So what they do is they give you the benefits of both worlds. So you get your guaranteed life annuity, which could then cover your bread and butter, so your fixed expenses, and then you could top that up with a living annuity, and you can then have a little bit of flexibility in terms of increasing and decreasing the percentages. So that's quite nice. I think that's pretty much it in terms of the journey I wanted to explain. And now what I'd like to do is just go into each of the products in a bit more detail, just to give you some specifics. So the first one I'm going to go through is in the voluntary space, and it's a unit trust or a LISP investment. I'm just going to run through it quite quickly because it's basics in terms of, it'll be similar on each slide. So once you get used to the format, you'll be able to go through it quite quickly. So the first flag was basically your contributions. So recurring debit orders are allowed. Minimum contributions for majority of the companies is 500. Lump sum payments are allowed, and the minimums there vary depending on the service provider, of between 5,000 and 25,000, and it also depends on the portfolio that you're investing in. Ad hocs are allowed. That means that additional contributions at any point of the lump sum amount can be added into those portfolios at any time. And then you can cancel and restart your debit order if you've got a fixed monthly debit order at any time without penalties. And that to me is a real big advantage, especially today, based on people's uncertainty in terms of their job security, etc. You need to know that whatever you're investing in, you do have the ability to stop contributing if times get tough, and then be able to start it again at a later stage without having to incur penalties. The traditional life insurance companies, unfortunately, still carry massive penalties on their investments, and that's obviously, that wouldn't fall under this product type. That would be more the endowment structure. So just be very careful in terms of penalties and what you're signing into when you're taking out a contract. It needs to be flexible to be able to suit your changing needs. The blue flag, the light blue flag, then goes on to the tax implications in terms of the growth that you are earning in this product. So dividends withholding tax will be taxed at 20% if you are earning dividends. So you might be invested in a money market portfolio, therefore not deriving dividends at all, therefore the 20% won't be applicable. But if you are invested in a portfolio that is earning dividends, then obviously the 20% would be taxed, and it is paid over in the background by the service provider to SARS on your behalf. Then you've got rental and interest income, which is taxed at your marginal tax rates. Okay, and this is I think a big thing that people sort of misunderstand as well. So it could be as low as 18% and as high as 45%, depending on what your marginal tax rate is. There is an annual interest exemption, which hasn't been increased for quite a while. Currently, if you're under 65, it's 23,800 Rand a year, and this is the tax year, 1 March to 28 Feb. And if you're over 65, it's 34,500 Rand. The problem is, I think a lot of people get confused because they see their products in isolation. So these exemptions are across the board for everything that you have. So should you have a share portfolio or something else that's deriving or earning rental or interest income, you then potentially could be over the threshold, and that's when you would start paying tax. Okay. CGT at 40% times the marginal tax rate or your marginal tax rate, and it only triggers on disposal or switch. In other words, if you cash it in or you take some money out or you switch into a different portfolio. There is also an annual exemption of 40,000 on capital gains tax, but again, it's aggregated across all capital gains on your portfolio. Okay. There's no term. The green flag is no term, or the term to the contract. In other words, how accessible is the money? Is it liquid? Is it illiquid? So there's no specific term to these products. So you can start it today and stop it tomorrow. You can put it in today and cash it out next week. It's usually 3 to 5 working days, and the money should be back in the bank account again, depending on the service provider. The yellow flag is, are you able to nominate a beneficiary? Okay. Or would it form, and how does it form part of your estate? So both on a unit trust and a list investment, it's very similar to your bank account. So there is no nominated beneficiary. Those proceeds, if you were to pass away, would transfer into your estate late account and get tied up until your estate is wound up, which is a disadvantage, but it does provide liquidity in terms of an estate. So for somebody that perhaps can't get life insurance, if they have enough money invested in a unit trust, that could fund estate costs potentially. The orange flag is the executor's fees and estate duty applicable. So obviously in this instance, because it becomes part of your estate, it then definitely does attract executor's fees, and estate duty would also be applicable, unless you are specifying that it goes directly to your spouse, which would be a 4Q deduction, but both of those fees would apply. The last blue, or the dark blue flag, would be the tax deductibility of the contributions. So the contributions are not tax deductible. You're paying with your after-tax money into both of these products. I put a key at the bottom just for the people that don't understand my acronyms. So DWT is dividends withholding tax, and that's currently 20%. CGT is capital gains tax, and that's currently for an individual 40%. Then executors' fees are currently 3.5% plus VAT, and remember VAT is at 15% now. Then estate duty is 20% plus 25% if your estate is valued over 30 million. So it's just for the value over 30 million that the 25% will apply. That was a recent change in legislation last year. So that's unit trust and LISP investments in a nutshell, and I'm going to run through the other 7 pre-retirement products in a similar way. So bear with me, and I'll go a bit quicker now because obviously you understand my concept. So the next voluntary product would be an endowment, and I think everybody knows an endowment. It's been around for many, many years. I think it's been terribly missold, unfortunately, in my experience, and people are under the impression that the proceeds are tax-free, which is definitely not the case. So just to go through the basics again, I mean, I wouldn't suggest any investment is worthwhile if you're paying less than 500 Rand a month at the moment, more in terms of fees than anything else, because any provider that's offering a debit order facility for less than 500, you need to check what the fees are, because unfortunately they then become traditionally the insurance houses, and there's lots of fees and costs hidden in and amongst those debit orders. So minimum is 500. Lump sums are available. Some of the endowments are one or the other. You can't do a combination of both. Okay, there would be separate endowments if you're doing multiple transactions. So I put Hollard in brackets there because that was the one endowment that I do recommend to my clients, and I think it's got a unique set of benefits which the traditional endowment does not offer, and the minimum is 100,000, so it's quite a high barrier to entry for perhaps the lower income earner, but in order to save up to get to that, I think the benefits outweigh the weight. Ad hocs, you are allowed to do ad hocs into endowments, but it's subject to the 120% rule. So traditionally, I would rather just say, if you're going to do an ad hoc, potentially you might want to start something new, or we look at a different product, because it just becomes very complicated in terms of the tax rule. You cannot stop or restart debit orders on these products. So in other words, once you're in for the 5 years. If there is any reason that you have to cancel or withdraw early, which very seldom actually is allowable, there would be substantial penalties applicable. Next, we come to the tax on the growth. So it's under the 5 fund approach. It falls under the individual policyholder fund, which means, and this is where the tax thing comes in, where everybody thinks that your proceeds from an endowment are tax-free. They're not. They paid over on your behalf by the insurer to SARS, but it is at a preferential rate. So the individual policyholder fund pays dividends withholding tax at 20%, which is the same. It pays rental and interest income tax at a marginal rate of 30%. So the person who would benefit from an endowment would be an individual who pays more than 30% marginal tax rate. Anyone who's under 30%, potentially this might not be the right product for you. I'm not saying it's not. I just think that you need to be aware of the fact that the tax-free punt that everybody has been using for many, many, many years on this product is actually, it's incorrect. Capital gains tax is also taxed at an attractive rate, a lesser rate than you would if you were in your individual capacity. So it's at 12% instead of 18%. The reason I suggest and I recommend Hollard is because should you invest into their Hollard, it's a very specific product, and you invest in the Hollard portfolios, you then pay a zero capital gains tax and a zero income tax. So from that perspective, it doesn't matter whether you're under a 30% tax rate, you then get the benefit of not paying any tax at all in an endowment structure. Okay. If you need any information with regards to how that product works, as I said, the only disadvantage of that product is it's got quite a high minimum lump sum entry level of 100,000. Then moving on to the term, all of the endowments have a minimum of 5 years, and that is for tax purposes to give you the 5-fund approach, that individual policyholder fund, tax benefit of paying less on income tax and capital gains tax. You are allowed one part withdrawal or one full surrender within the first 5 years. And the trick here is a lot of the companies offer you the option where they bundle your money into sub-policies. So you have, let's say you invest R1 million, and each bundle has to be a minimum of 100,000. You would then have 10 bundles of 100,000 under your R1 million umbrella policy, and you would then have access 10 times to that money, because you would have access one part withdrawal or surrender to each one of those 100,000 bundles. So a lot of the companies have done a workaround in terms of those restrictions, which is quite nice. So you could almost stagger your need if you plan correctly, so that you could then, in 5 years' time, if you were 55 and you were planning to retire at 60, for example, you could then plan it that the policy matures and after the 5 years at 60, and then you can start withdrawing from each bundle to top up your shortfall, for example, from when you retire from 65 onwards. The nominated beneficiary, that's the benefit. That's probably the biggest benefit, and that's one of the reasons the endowment, I think, has been sold so much, is because it has a nominated beneficiary, which means that the proceeds will pay to who you specifically nominate. The only disadvantage I can tell you in reality is that people don't update their beneficiaries regularly. I think I've had a couple of clients where the person has passed away and it's an old beneficiary, and unfortunately it's a contractual agreement between the insurance company and the life assured. So they have to pay to whoever it is that you have nominated. So it is a pro, but it could be a con at the end of the day as well. There will be no executors' fees if the nominated beneficiary is a person. Obviously, if you've nominated the estate, then it becomes an estate asset. There would be executors' fees, but that would be silly unless there were specific reasons for that. But there will be no executors' fees, but the estate duty would apply on the value of the proceeds. And that is purely because it becomes, and it's a deemed asset in your estate, unless there's a 4Q deduction, and that's only, unfortunately, applicable to married couples, and it would be if you've bequeathed your estate to your spouse, then there would be no estate duty. Contributions are not tax deductible and again paid with after-tax money. The note that I put in there is it is only beneficial 90% of the time on the traditional endowment platforms if you are paying more than 30%. With the exception of Hollard, as I said. I suppose the people, other brokers might criticize me for that comment, but for me, unless it's very specific and there's a need for it, there are other products that you could possibly be investing in and getting the same or better benefits. than an endowment. Okay. Next up is a participation bond. I have a contract with Fed Group. I'm not really aware of any other participation bonds on the market. The way I could explain this is it's very similar to a fixed deposit, a 5-year fixed deposit or a government bond type investment. So contributions, you can't contribute to it monthly at all. So it's lump sum investments only. The nice thing is that the barrier here is quite low. So the minimum contribution is 5,000. And you cannot put additional contributions into this product. You would then have to start a new one. Tax on the growth, there's no dividends withholding tax and there's no capital gains tax because you are only earning interest. So it's only interest income taxable that will be taxable, and it will be taxable at your marginal rate. So minimum 18%, maximum 45%, and then the individual exemptions apply under 65 and over 65. It carries a 5-year term, and there are limited withdrawals allowed. And these are only under very specific circumstances. So you just need to be aware when you're investing. That's the other thing that I think is critical, is you understand what is your out, what are the circumstances. Because if you put everything in one place and something happens and you need funds and you're in something like this, for example, if it's not one of those situations that's part of that limited withdrawal allowed, you're going to be in trouble. Okay, so you need to make sure before you invest in whatever product you choose that it will fulfill the specific needs that you're looking for. There's no nominated beneficiary, so the proceeds would pay to your estate, and again, wait until the estate gets wound up and pay according to who you've nominated. Executors' fees and estate duty would apply to the proceeds because it becomes an asset of your estate, so it's very similar to a bank account and a unit trust. And then the contributions are not tax deductible either, and they are paid with your after-tax income. Currently, the fixed rate that Fed Group is offering, unfortunately, it's dropped quite a lot. Obviously, we've had a massive interest rate decrease since the beginning of the year. So these rates are directly linked to interest rates. So they can only hold on to their rates for as long as they possibly can, and then obviously they fall in line with whatever the interest rates have done. So up until yesterday, it was 7.8. It's now currently 7.6%. It's a fixed rate. You also have the option, which is new to their product, where you can get a variable rate, which then allows you to buy in. And if the interest rates go up again, you will get the benefit of that. But if they go down, you will go down. On the 7.6%, that is the fixed rate for the full 5-year term. So this gives you that certainty. You know, this particular product is well suited to retired people who are risk averse. They don't want to take risk with their money, and it's money that perhaps they've inherited. So it's voluntary money. They don't have to put it into a living annuity or something like that. You can. The nice thing about this particular product is you've got options. So upfront, you can choose whether you want to draw an income or the interest, or you want to reinvest the interest over the term. The good thing is if you choose to reinvest it and 6 months down the line or a year or two down the line, you decide, well, you need to actually start drawing some of that income, you can then change your mind, and vice versa. So it's quite flexible within the product. The only inflexible part of it is that it's fixed in for 5 years. Okay. But the one thing I can say to you is that guarantees come with term. So any short-term or liquid product, you're going to find there practically, or there are no guarantees on those products for a reason. The only reason that they can offer guarantees on the fixed-term contracts is they can then invest in things for a longer period and give you that higher growth rate, or the guarantees. Okay. Next in the voluntary space is the guaranteed investments with or without income. So again, hindsight has proven very valuable to us. I think even before COVID, the balanced funds have not performed over the last 5 years. Cash has been king. So these kind of investments that carry guarantees have been something that people, I think, that have had them have been very grateful for having them, and that haven't had them have wished that they did. So these particular products are, again, no recurring contribution, lump sum only payments, no ad hocs allowable. So the last 2 or 3 products are very similar in terms of how they work in terms of contribution. The tax on the growth, it's the 500 approach yet again. So favorable in terms of the 30% income tax and the 12% capital gains tax. It carries a 5-year guaranteed term. So if you invest R1 million today, they basically, if you're choosing to take an income out of it, they split it in two. They put a portion of the money into an annuity, and that pays you the income that you asked for upfront. And then the rest of the money gets invested into something that carries a guarantee to be able to pay you back that R1 million after 5 years or at 5 years. If you choose no income, what they do is they invest the full R1 million and they say they're going to guarantee you, call it 5.5% in 5 years' time. And that's it. There is no changing, there is no flexibility in this product. You can't go back and say, okay, I didn't take the income up front or I didn't take the interest up front and I want to change my mind. You can't do that, and vice versa. So you are in and fixed, even less flexible, I think, in terms of income needs and changing. But it definitely has a place, as I said. And your portfolio, I think, at the end of the day needs to be made up of multiple products, not just one, because then you've got the ability to carry guarantees on certain parts of your money and then the flexibility on other parts. There would be a nominated beneficiary on this product, again, because it's an endowment type structure, so the proceeds would pay to your nominated beneficiary. There would be no executors fees on this product, but obviously estate duty would apply unless there's a 4Q deduction, okay, which is bequeathed to you, bequeath your estate to your spouse. Contributions are not tax deductible, again, paid with after-tax money. The options is upfront, you can choose to withdraw the income. As per tax tables, it will be taxed, okay? And then you also have the choice upfront to reinvest it. So there's only really two choices upfront. Do you want to draw it out, the income, or do you want to leave it to be reinvested? Okay. So you can see the starting off on the shorter term products, the flexibility is much higher, but there's tax disadvantages or there's tax implications and estate implications. The further you go along this journey, or in terms of the time frame that you're investing the money, the more tax advantageous it becomes, the more estate duty and executive fees advantageous it becomes as we go along. Okay. Then, as I said, probably my favorite product, I think of that's been available for quite some time. We don't get much for nothing. So when government launched this a couple of years ago, for me it was a no-brainer. I like to encourage all my clients to have this as their base of their top up to retirement fund. Okay, so although it's a voluntary savings vehicle, I do think that it should, in your mind, become a compulsory one. So it mustn't be one that you can access. As I said, unfortunately, I think it's been advertised incorrectly by some of the banks and service providers to say that, yeah, invest in the tax-free savings because it's liquid and it's fantastic and flexible, and people are taking the money out and they don't realize that they can't put it back. So once you've taken out a lump sum investment or an amount out of that tax-free savings, you can't put that money back. So you've lost the advantage of the 500,000 that is given to you in a lifetime. So contributions, minimums are 500 a month, lump sums are available. You can do a combination of both, as long as you don't reach and go over, as long as you don't go over the 36,000 annual limit. If you do, they will tax you 40% of any amount put into the investment over and above the 36,000, which is not what we want to do. Ad-hocs are allowed. Depends on the insurance companies or where you're investing. They've got minimums in terms of ad-hocs. And you can, the other nice thing is it's very similar to a unit trust because the underlying funds are unit trust funds. You can stop and start your contributions pretty much with no penalties. And again, this is only assuming that you are investing in certain companies like listed companies, because other companies carry the endowment type structures, therefore they have penalties, etc. when you get out and when you change things. Everything is subject to the annual limits. The best thing and the most advantageous thing about this product is there is no tax on the growth. No capital gains tax, no dividends withholding tax, no income tax. Okay. All the other products that offer no tax on growth fall under the compulsory space. So this is the only voluntary product that you can choose to invest in. That is your product, that is not restricted in terms of any regulations other than you cannot put more than 36,000. So my suggestion would be, if you have 36,000 Rand a year, the first 36,000 you invest into the tax-free savings, into a tax-free savings policy. And I know a lot of my clients know that I recommend this for their kids, even if they're 2 years old. This is a much better investment for when you're investing for your child, to give them that 18-year birthday present that I think a lot of people, I mean, that's quite an old way of thinking, but I think we all still think the same way, that we'd like to give our kids something. What better way to give them a tax-free savings policy that you've probably already, by the time they get to 18, have invested the 500,000. Whatever the growth is they've made on that is tax-free, and they can then either carry on with the product and use it for their retirement, or alternatively they could buy themselves their first house tax-free, a car, you know, things like that. Lifetime limit maximum was 500,000. I did tell you that the current, they have increased it, so it was started on 30,000. It then went up to 33,000, and it's now 36,000. So, but the maximum lifetime limit has not changed. So I don't think that that would change. To be honest, I think that's still going to stick where it is. So it's about a 15-year term if you start today, if you manage to contribute the full 36,000 every year. If you don't, it's no train smash, but you can't catch it up next year. So in other words, if you manage to do 30,000 in this tax year, and remember this tax year, all of this revolves around from the 1st of March until the 28th or the 29th of February. So it's all tax year based, and it's per natural person as well. If you don't manage to do it, and you only manage to get 30,000 in for this tax year, you cannot put the extra 6,000 in next tax year. It will tag onto the end of the term of the contract. So in other words, although it doesn't have a term, it just makes, it's until you get to the 500,000, however long or short it takes you. It can't be shorter than 15 years, but it could be longer. Nominate a beneficiary, yes, but only with certain providers. And Alan Gray is an example of one of the providers that, or the only provider I recommend to use for the tax-free savings for a number of reasons. One, it's still an investment company, therefore it understands, and their cost and their fee structure is advantageous to the client and to the client's benefit. And number two, it's flexible and their service is excellent. Okay, so I know initially Old Mutual was the first one, I think, to launch with a nominated beneficiary. But since then, obviously, quite a number of the other companies have launched. Remember, if it is on a life license under the insurance company or the unit trust company or the risk platform, then it would be able to be nominated as a beneficiary, but only some of them. For example, Discoveries, you cannot nominate a beneficiary, it would form part of your estate. So a bank or a unit trust provider, remember the proceeds will actually then go back into your estate late account as if it was a bank account, which makes no sense to me at all, because then whoever is going to inherit it, which you could have nominated on one of the other platforms, would have to wait for that money. Up until recently, I think it was last year, government didn't allow you to transfer from one tax-free savings to another. You can now transfer. So that's also quite nice, is that if you happen to have opened one at the bank, not knowing that, you know, there was a difference in terms of nomination of beneficiary, etc., you are then able now to transfer that money over and start one that has got a nominated beneficiary, and you carry over the tax benefit, and you get a tax certificate basically, and it will accumulate for whatever tax year you put that money in. Okay, which is quite nice. So then you're not ending up with 3 or 4 different tax-free savings, which is complicated. And then you also run the risk that potentially you could go over the 36,000, which we don't want to do. There would be no executor's fees, but estate duty would apply, obviously to the value of the proceeds, again, unless there's a fortune deduction to your spouse. Contributions are not tax deductible, paid with after-tax money, but you would get an annual contribution certificate from SARS just to provide confirmation of the amount of money that you have contributed into that tax-free savings. Note, withdrawals are allowed, fully liquid. It's as if it's a unit trust. However, once you've taken the money out, as I said previously, you cannot put it back. So I don't like to emphasize the fact that it is liquid, purely because I don't want you to know and then utilize this as your emergency fund. This needs to be your long-term savings fund. But the nice thing about this, and this is why I like to make this the foundation of your financial plan in terms of your savings Obviously, once you've got your slush fund set up, and if you need a holiday fund or anything like that through a unit trust or some other short-term investment, is because if anything happens, a lot of people are immigrating, a lot of people's lives change, things happen, the money is available and liquid, okay, and not subject to any regulation. The sixth product that we're going to quickly run through, you can either have this as an individual or as under a group, and it's a retirement annuity. Again, a retirement annuity has been around forever and ever. Pros and cons, I think right now with all the media coverage with prescribed assets and Regulation 28 and all sorts of things and the government, I think everybody's quite nervous about these products. However, yeah, I think you need to understand that the media is definitely trying to create chaos. They're very good at this. A couple of years ago, they did the same thing when they were trying to convert provident funds to pension funds for the right reasons, but it was communicated very badly. So there was mass pandemonium, and everybody panicked and wanted to resign from their employers because they wanted access to their provident funds. So I think this is hopefully a similar situation. But obviously, if anything ever changes, you guys, as my clients, would be the first to know. And we would then have to make changes that would be necessary to your portfolio to take that into account if something like prescribed assets comes into play. So contributions, recurring contributions of minimum of 500. And it depends on your circumstances. I have clients that are salaried employees that like to contribute monthly. I have clients that are contractors or businessmen, and they like to sort of calculate it at year end in February and then just do one lump sum payment to get the tax advantage. So yeah, I mean, it's fairly flexible in terms of contributions. Again, unfortunately, only with the unit trust and list providers, the traditional insurance companies still carry quite a lot of fees and costs and restrictions and penalties if you make changes to the old RAs. So you can stop and start contributions whenever you want to, as long as it's on a list or unit trust platform generally. And Regulation 28 would apply. And Regulation 28 basically restricts how you invest the money in terms of your asset classes, in terms of property, bonds, cash and equity, and then local versus offshore. So how government is planning to bring in the prescribed assets legislation is just to make a change to Reg 28. That's how they can do it. Let's hope they don't. There's no tax on the growth. Again, so remember, the only other product that allows for no tax on growth in the voluntary space would be the tax-free savings. So all the retirement fund products, so the retirement annuity and the next two that we're going to go through, also have no tax on growth. So there's no dividends withholding tax, no income tax, and no capital gains tax. So that's a big plus. Minimum retirement age is 55. So you cannot access the money. And this is a big disadvantage, especially on the group side. I don't see it as a disadvantage, but the members and the employees generally do. But I think that's a lack of education or a lack of information that is given to people, because they are not accessible to protect you from yourself. Because if they were, they would have been used and blown like pension and provident funds have in the past. So the minimum restriction of 55 is just so that if anything happens, that money is there to pay you for your retirement. That's what its purpose is, and that's what it's meant to do. So they're trying to discourage people from accessing that money, and that would be the only way that they could do it. And that is why South Africa has such a rich retirement industry, or that's why government is, and all this hoo-ha is going on about being able to access our retirement or our pension funds, because we're probably one of the few countries in the world where individuals have had to make provision for themselves. So there is a lot of money invested in retirement funds, both on an individual and a group level. So that money needs to be protected from the members themselves, because unfortunately we're our own worst enemies. At retirement, okay, the only time below 55 that you could access that money would be if you were disabled, totally and permanently disabled. or if you immigrate from South Africa, and that would need to be a formal financial immigration. They're planning to change the legislation next year. It's proposed that they have a restriction of 3 years on the withdrawal for immigration purposes. I will distribute a bit more information about that when we get it. But as I said, I spoke to a client recently, and that's pretty much the time frame on most countries it takes to get your citizenship in place, and then only would you be able to do the formal immigration. And a lot of South Africans don't formally immigrate in terms of financial immigration. So the money would be stuck here till minimum age 55. At retirement, you can take a maximum of 1/3 in cash, and then you are restricted with the 2/3, minimum 2/3 has to purchase an annuity. So when I say minimum, that means you can choose to invest the full amount. You don't have to take 1/3 in cash. You can reinvest the full 3/3, into an annuity. I think a lot of people take the cash because they think they have to. They don't have to. And it might not be in your best interest to take that 1/3. And I'll come to that just now. You can nominate a beneficiary, but what's very important to remember here is that all retirement fund products are subject to Section 37 of the Pension Funds Act, which basically means in English that the trustees of the fund have the power to overturn your nomination, because they might find that you have legal or factual dependents, people that are 100% or partially financially dependent upon you, and you haven't nominated them as a beneficiary. So they can overturn your decision, your request or your wish, and they can then proportionately distribute the money to wives, children, family, whoever it is. So that's something that's quite important to remember when you're nominating beneficiaries on your fund. Make sure that try and give the most information that you have available to ensure that when and if something happens to you, that the money gets paid to who you want it to go to, because they have up to 12 months to make that decision. So it could delay money that you think is enough to pay your beneficiaries and your family if anything happens to you, but it could be delayed for up to 12 months because of complicated affairs. Okay. There's no executor's fees and no estate duty, which is the biggest benefit of a retirement, or one of the biggest benefits of a retirement annuity. So it's completely outside your estate. It doesn't even show as an asset. So very, very attractive. Contributions are tax deductible. And this, I suppose, is the biggest selling point for an RA over all the years I've been doing this, which is nearly 21 years. I think it's 21 years next month. So at the moment, the current legislation says it's a maximum of 25.5% of taxable income, or 350,000, whichever is the lesser. So it's up to 350,000 or 27.5% of your taxable income. You can contribute towards a retirement annuity. And remember, they've amalgamated this, guys, with everything. So it's including pension fund contributions and provident fund contributions. Previously, provident fund contributions fell without or outside of this tax deduction. Now it falls inside. So it's not that you can't contribute more. You are welcome to contribute more. It's just saying that you won't get the tax deduction, and that tax deduction will be carried forward year on year until you retire. Okay. So that, I think, is one of the reasons that RAs were so popular and have been oversold, or maybe oversold is the wrong word, but have been sold so much purely because of the tax deductibility of the contributions. I think a lot of people are quite nervous and quite wary. I've read a lot of articles recently where clients are panicking and stopping contributions to RAs because of this whole prescribed assets thing. I said, my advice to you guys is don't panic. I think the industry is big enough that, you know, if anything were to change or be in line to change, the industry as a whole would fight it. It would have to be a very good reason for them to make changes without the industry having some kind of backlash. So please don't panic. If there's anything that you're worried about, or just let me know before you make rash decisions, because sometimes it won't be in your best interest. And acting on emotion is definitely not the right way to make a decision, especially when it comes to money. Just a couple of things that you can note. The first is, if you are under 55 years old and you have a paid up retirement annuity policy with any service provider of less than 7,000 Rand, you can surrender it. You can cash it in, no tax. So if you've got any of those lying around and you just want to get rid of them, that's the maximum the value needs to be. Then the second thing is if you're over 55 years and the value of your retirement annuity is 247,500 Rand. I don't know where government got that number from, but they did. You can also cash in the full amount. So that was what came about when they tried to convert provident funds to pension funds. So they've pretty much given full access to a pension fund in any way, which defeats the whole object of what they were trying to accomplish. But anyway, the one thing you just need to know on that second note there is it is per service provider. So for example, if you've got an RA with Liberty and you've got an RA with Sanlam, and each one of those independently is below the 247,500, you can cash both in full. However, if you have a RA with Liberty of 80,000 and another RA with Liberty with 100,000, again, it's the amalgamated amount, so you would be able to cash it in. If the two together go over the 247,500, you would not be able to cash it in, okay? Because they aggregate the amounts of the retirement annuity funds under the umbrella of the service provider. In other words, Liberty, Old Mutual, Sanlam, Momentum, okay? Seventh product, and then there's just one more to go, and then we'll go to the post-retirement phase of the presentation. So pension and provident funds are employer-owned funds, and this is the compulsory space again. So retirement annuities, pension provident funds, and preservers are the three compulsory products that are available. This particular product, the pension or provident fund, can only be owned by an employer. So an individual person cannot contribute to a pension or a provident fund as an individual. There has to be an employer-employee relationship to create a pension or provident fund. Up until now, it's also been quite expensive to run a pension or provident fund. So the smaller type companies, the SMEs, generally don't and can't afford to go into a pension or provident fund. That's where the umbrella funds started coming about, that they could pool the costs and then have multiple employers under one big umbrella fund. The alternative for the smaller guys is to do a group RA. So you just facilitating the payroll and the contributions through payroll. However, the retirement annuity belongs to the individual. So should they leave your employment, they can actually continue with that policy as a group RA, whereas on a pension and a provident fund, you physically have to resign from the fund. There have been quite a few changes in terms of that. I'll go through that with you now. So contributions, obviously recurring is the way to go on this, and that would be the norm. And it's usually based as a percentage of the member's salary, or it's a fixed rand amount. You can do lump sum payments into a pension or provident fund, and you can do voluntary ad hoc contributions as members as well. Again, subject to Regulation 28, and obviously all the deductions and contributions would be made through payroll. There's no tax on the growth, again, on these funds. It's compulsory money. The minimum retirement age, same as what I said with the retirement annuity, is 55. The minimum retirement age on all retirement products in South Africa is 55. Traditionally, pension and provident funds, the employer has chosen 65 or 60. It's actually coming down. It should be going up, but 65 is probably the most common retirement age on an employer fund. At that age, then the employer would either say you're going to have to go onto, from a permanent contract, you'd have to go onto a temporary contract, and then you would no longer be eligible to belong to the pension or provident fund. The nice thing about a group RA is that you don't have that problem, especially when it comes to members over the age of 65, because there's no limit in terms of age. At 65 or 55 minimum, you have the option to, this is prior to retirement. So this is before retirement. You leave the employer for whatever reason. You resign, you get retrenched, or you're dismissed. You are able to withdraw 100% of your pension or your provident fund proceeds in cash. And this is, I think, the biggest disadvantage. They are trying to encourage preservation, and I've said there, please preserve your money. I think I went to a Liberty presentation a couple of years ago. I don't think it's changed much, but I think their stats then were 8% of their members were preserving their funds. That's quite horrific if you think about it, because this money was allocated and paid towards a retirement fund for the member, and the member quite comfortably can cash it in and pretty much blow it on anything prior to retirement. So I think the government's drive initially when they were trying to do this whole change in legislation was to try and protect that money for the member. As I said, it was unfortunately misinterpreted by most. At retirement, if it's a pension fund, you can take a maximum 1/3 in cash and 2/3 must purchase an annuity, very similar to an RA. If it's a provident fund, you are able to take a maximum of 100% in cash. But again, I just want to remind you that you don't have to take any money out of a provident fund. You can commute the full amount or a part thereof into an annuity as well. Retirement tax tables would apply. Obviously, if you are withdrawing prior to 55, then the withdrawal tax tables would apply. And there's a massive difference between the two in terms of what is tax-free and how the brackets are calculated for the percentages of tax. I'll show you that now. You could nominate a beneficiary, but again, subject to Section 37. So your trustees would make the decision in terms of if they can find legal or factual dependents that you haven't informed them about. No executor's fees, no estate duty, falls outside your estate. Contributions are tax deductible. I mentioned that previously. The notes here is on a pension fund, if you are over 55 and the value is below 247,500, you can cash it in full. And as I said, that was what I think government didn't anticipate. I think they did it to appease the unions, but that's my personal opinion. Don't quote me. But it sort of defeats the whole object. But anyway, withdrawal tax table would apply if you are under 55 and you withdraw or you immigrate. Okay, even if you immigrate and you post 55 and you think you're retiring, you will still pay the withdrawal tax table rates. Okay. Last one on the pre-retirement side, and it's a compulsory, obviously compulsory one as well. This is when you get dismissed, you resign, or you get retrenched from your employer group. As I said, it's a compulsory fund. The previous one, and it's employer owned. Therefore, if you resign or are no longer eligible to be a member, there's no employer-employee relationship. You need to move that money and park it somewhere else until you retire. So there's no recurring debit always allowed on this product. So you can't contribute to a preservation fund again unless you happen, and that's the third point there, you can do an ad hoc into this only if you happen to work for the same employer twice or more, which I never thought would happen, but it does happen more than you think. So that means you join and you start working for a company today, you resign in 3 years' time, you preserve the money, you work somewhere else, and then you happen to go back to the first employer and work for them for a couple of years and then resign. If you resign the second time, that money can then be put into the same preservation fund. So it's a lump sum only. Minimums vary depending on the company that you invest with, and Regulation 28 would apply. There's no tax on the growth. The minimums are pretty much the same as all the retirement investment products. So minimum age 55, unless you're disabled or you immigrate. One part or full withdrawal allowed prior to 55. So you are allowed to access the funds once before you're 55, either partially or in full. That would attract tax according to the withdrawal tax tables though. At retirement, if it's a pension, you can take 1/3 in cash and 2/3 must buy an annuity. If it's a provident fund, then it's you can draw a maximum of 100% in cash, and then the retirement tax tables would apply. Guys, the only thing I want to just stress here is, remember, it must go pension to pension, provident to provident. So if you're resigning from a pension fund, you must transfer those proceeds into a pension preservation fund. Don't go across, because then tax would apply. If you're coming from a provident fund, you must go into a provident preservation fund. A lot of my clients often are advised by their corporate brokers or the companies, etc., that they're on a provident fund and they must put it into a retirement annuity. That would be detrimental to your plan, because a provident fund has very specific tax benefits at retirement that then you would be restricting. So you would then lose the 100% accessibility and be restricted to 1/3, 2/3. So just please, if you're ever retiring resigning, or you've been retrenched, please get in touch with me so that I can give you those pros and cons and double check which kind of fund you're on. Okay. Nominated beneficiary subject to Section 37, same as the previous two products. No executors fees, no estate duty, and then the proceeds would transfer tax-free from the employer's pension fund or provident fund directly into the preservation fund. They apply at SARS for a tax directive. It goes through at a 0 tax rate. And the things that would trigger the preservation would be resignation, retrenchment, and dismissal. The withdrawal tax tables apply if anyone is under 55 and withdraws the money out of their pension or provident fund, or if they immigrate. So that's the pre-retirement space in a nutshell, and that would then apply, the tax table that would apply to pre-retirement withdrawals would be the one on the left. So up to 25,000 would be zero tax applicable. Then between 25,000 and 660,000, you're going to pay 18%. And then it's a sliding scale up. You can see on the retirement or severance package, so that's retrenchment, you get, even if you're under 55 on the severance side, it's favorable in terms of the tax. So you get 500,000, the first 500,000 tax-free, and then it becomes a sliding scale again. And you can see the brackets are slightly better off on the retirement tax table than they are on the withdrawal tax table. Not much, but a little bit. Okay, but the tax itself is definitely significantly less on the retirement versus the withdrawal. So to withdraw just costs you money and you pay more money over to SARS, which I don't think is anyone's intention. Okay, so that's the pre-retirement covered. Post-retirement, as I said, guys, I don't want you to think that I've covered every kind of product or option that's available. I've just done the ones that I think are relevant and valuable, and the ones that I often propose to my clients. So there could be others, and there probably are many others that are available. Share portfolios, you know, those kind of things. We can do an extra session on that if you'd like. In the post-retirement phase, I don't want you to ever think that, as I said in the beginning, that you don't continue with your pre-retirement tax-free savings, endowments. A lot of those things will come in very handy post-retirement. So all I'm going to focus on here is the two products that you can choose when you physically retire from either your pension fund, your provident fund, preservation fund, or your retirement annuity policies. So this is, again, the compulsory space. The first product that is available is either a living or linked life annuity. It's got different names depending on the service provider. This particular product has been very popular, and in hindsight, I think a lot of people have, again, been kicking themselves that they wish they'd been in a guaranteed annuity, purely because of poor market performance and obviously what we've been through with COVID and interest rates dropping, etc. So contributions, no recurring contributions are allowed into this product because it is a transfer product from a pension fund or a provident fund or a retirement annuity. So it would be a lump sum transfer only. Adults are allowed, but only if it's coming from a compulsory source. In other words, and it doesn't have to be the same company again. So you could have a retirement annuity with Allan Gray, and you could have a preservation fund with Sanlam. And you may decide at 55 that you want to commute your Allan Gray RA into a living annuity, and then 3 or 4 years later, you would like to commute your Sanlam preservation fund into the same living annuity. You can do that, so long as it's coming from a compulsory source. Okay. This particular product can only facilitate or hold compulsory money. You can't voluntarily have won the lotto or inherited some money and go and put it into a living or linked life annuity. Okay. There's no tax on the growth on this product. Minimum, the earliest you can take one of these products is 55. So you have to reach retirement age in order to qualify to get into this particular product. The income drawdown, and this is what has made this product, I think, as attractive and as easily sold as it has been in the past, is that you can choose. There's certain options that you can choose. One, you can choose a minimum withdrawal of 2.5%, up to a maximum of 17.5% of the capital per annum. That then can be paid in different frequency amounts. So you can say, all right, or frequency levels. So you can say, all right, I want to have it monthly. I want to have it annually, I want to have it biannually, or I want to have it quarterly. So there are those two options. The recommended percentage drawdown, and this is what we discussed in the previous presentation, Shwave, is that obviously the ASISA has come up with certain statistics and recommended amounts, and 5% I would say is pretty much the maximum that they recommend that you draw in order for the income to be sustainable for your lifetime. So if you're drawing anything more than that, then potentially you could run out of capital. There is no capital guarantee on this product, and this is the risk, and this is what people have been feeling, I think, in the last 5 or 6 years, purely because they've been drawing, even if they've been drawing 5%, markets have not performed, they then have started eating into capital, which is quite scary. And it makes your future uncertain, because if anything, everything is going up. So the 5%, the capital should have gone up so that you can then be drawing 5% on a higher value next year to keep up with inflation. But that's unfortunately not what has happened. Income tax is taxed on that income according to the SARS tax tables. And I have a number of clients that have got and retired, in inverted brackets, off of their retirement products early, but have continued to work. So what happens is SARS doesn't see, well, if you've got a product and a living annuity with Allan Gray, and they don't see that you are earning any other source of income from your employer, they're only going to tax you according to the income that you're earning from this particular product. So what happens is, come tax year end, you might have a shortfall and you might have to pay into SARS, because your employer's only paying tax according to what they know, your living annuity company is only paying tax according to what they know. So that's the disadvantage, is that you are forced to take an income when potentially you might not want to, but you have to. Okay. There's something else I wanted to say on that. I can't remember what it was. Maybe it'll come to me now. No, there is a nominated beneficiary. Okay. And the one thing you can notice here that a lot of people are doing now as well. So instead of panicking about retirement annuities, they're converting those RAs, if they're over 55, into a living annuity, because you are not now restricted in terms of Regulation 28, not only from a prescribed assets perspective, but from an investment perspective. So you can invest 100% of this money offshore if you wanted to. So a lot of people are commuting their RAs to be able to get out of Reg 28 in order to have that diversity to invest offshore. There is a nominated beneficiary, so the proceeds will pay to a beneficiary. This, again, they can have it as a lump sum or as an income, which is quite nice. It gives them a bit of flexibility, the person who inherits the money. The only disadvantage I can see on this is that that person who inherits might not be really good with money, and I've had examples of that quite recently, and potentially they could blow that money if they take it as a lump sum or even as an income, and within a few years that capital could be gone if they're drawing the maximum. And that's probably, along with the flexibility in terms of being able to change the drawdown on an annual basis. So that was what I wanted to tell you. So every policy anniversary, so if you start the product and you commute your RA on the 1st of June, and it goes into the living annuity on the 1st of June, you choose this year that you only want to draw 2.5%, and you want it to be paid monthly. Next year, you've retired, and now you need more money, so you want to increase the drawdown to 5%. You can also change the frequency. You can say, okay, well, I want it upfront, or I want it annually, biannually or quarterly. Those changes, the two changes, the percentage drawdown and the frequency, can be changed on an annual basis every June, or whenever the policy anniversary date is. Okay. There will be no executive fees and no estate duty. Again, this product falls outside your estate, which is quite nice. Not even calculated into your estate's value. The proceeds will be transferred tax-free directly from the Employees Pension Fund and Provident Fund, preservation funds and RAs upon retirement. And when I say retirement, again, I said in the beginning, guys, it's not when you're physically retiring from your employer. You can retire at any time and can continue to work. This is just retiring from a retirement annuity policy product. Note, the other thing that I think is also quite valuable, and if you are uncertain, because it's a very big decision to make when you're coming up to retirement and you're trying to make the decision, do you go into a living annuity or do you go into a life annuity? How do you know which one is better? Because as I said, in hindsight, looking back, life annuities have outperformed living annuities purely because they carry a guarantee. How do you know which one to choose? The nice thing and the peace of mind aspect of this is that you can always go from one of these and move into a life annuity, but you cannot go from a life annuity back into a living annuity. So you can always, for example, if you retire off your RA at 55 and you decide, okay, at 70, you know what, maybe you don't want to have the risk anymore of having to worry about capital losses or market volatility, you can then convert this into and transfer it into a life annuity. Well, I've done a couple of those recently, and it just gives that person peace of mind. for those last however many years you've got the fixed income. There's no what ifs and buts. Okay. And then the last product before we close, life annuities. These are compulsory and voluntary products. So you can take, so this is different to the previous one, because before, remember, on the guarantee, on the living annuity, you cannot take voluntary money and invest in a living annuity. However, on a life annuity, you can take voluntary money and invest. T's and C's are slightly different, but the general gist is there's obviously no recurring debit orders, lump sum payments only, and no ad hocs on this particular product. Okay, so it doesn't matter if you retire off of one Sanlam RA this year, and 3 years later you want to retire off a preservation fund and put it into a life annuity, that you then end up with 2 different life annuities. Okay, because the everything on a life annuity is set up front. You can't make changes along the way. There's no flexibility once you're in. So the rates are guaranteed based on the life annuity rates at the date of inception. Okay, and it's literally on a weekly basis that those rates change. So if you say I'm going to, and that's why planning for retirement, we can plan today for 6 months' time, but in 6 months, many things could have changed in terms of those life annuity rates. Voluntary and compulsory, I've mentioned that. And the other thing that's quite nice about this is you can do a single or a joint life. So, for example, if you're married and you'd like to ensure that the money pays until your spouse passes, or the second one of you passes away, you can do that too. Obviously, that just means that you get a little bit less out now, okay, because it's obviously having to insure 2 life expectancies rather than 1. There's no tax on the growth. You have to be 55 years at least or older to go into one of these products. The income drawdown is fixed upfront based on the annuity rates at the time, and as I said just a few minutes ago, that they come out weekly. Frequency options you have available, the same as the linked life annuity, so you can choose monthly, annually, biannually, or quarterly. Again, all of this gets chosen up front. Nothing can get changed along the way. You choose your income escalation up front. You can have a 0% escalation, you can have inflation linked, or you can have a fixed percentage, and it's payable for life. That means it will carry on paying until you die. There are guarantees that are available on this product, but it comes at a cost. It's not a massive cost, but it comes at a cost. If you choose not to carry a guarantee, that means that if you last 1 month and you convert the money into a living annuity and you pass away, there's no nominated beneficiary on the rest of that money. In other words, it doesn't pass over to anybody else. If you nominate a guarantee term of 10 years, for example, you die in year 5, the rest of the 5-year term, up until it reaches its guarantee term, would pay to a nominated beneficiary. If you die in year 11, whatever's left in the product doesn't pass over to anyone else. Okay, and I think that's probably one of the reasons that these products were not sold, and maybe again it depends on your age, but 40 years ago they were very popular, they became unpopular, and now I think are becoming more popular again because of the certainty, but it's mainly because you can't bequeath and there's no legacy left after those guaranteed terms. So I think people are a bit bitter about that they want their money to be passed over, but understand that this product is costed over the life expectancy. So the insurance company loses if you live too long, and gains and wins if you live too short. Okay, it's a bit of a gamble. The income that you're earning is taxed as per the SARS tax tables again, as the previous product. Proceeds will pay to your nominated beneficiary only if you have selected a guarantee term upfront. And again, you can't add in a guarantee at a later stage. Every single one of the T's and C's of this product has to be done upfront. Okay. There's no executor's fees or estate duty on this product, and it transfers again from any of the pre-retirement products and a living or linked life annuity. It cannot be transferred back to a linked life annuity ever again. So once you are in for life. You can't get out of this product. Okay. I think that's pretty much everything in terms of the product specific things I wanted to go through. I just wanted to leave you with a couple of tips to remember. Things I've learned over 21 years that I wish I'd known a long time ago, and I should have started telling my clients a long time ago, but I think that comes with experience. Save 20% of your gross income from the day you receive your first salary. I think that's probably the most important thing I've learned in 21 years, because I realize that most people, savings is always the last thing that they do. I don't know why. I think it's a South African trait. But the very few clients I have had that have been able to retire comfortably have been saving on average 20% of their gross income every month since they started working. Today's generation of youngsters also, they don't really understand this whole saving concept because it's foreign to them. I just do think that if you can try and encourage your kids and try and teach them the good habits, I think it would definitely benefit them long term. Whether they stay in South Africa, whether they immigrate, it doesn't really matter, but it's just good habits. The next thing that I think is critical, and I think COVID has probably taught us harder than anything else, is that you need at least 3 to 6 months salary saved in, and I always say here, a unit trust account in case of emergency. As I said, some of my clients have got it saved up in a fixed deposit. Some of it is in a money market account linked to the bank account. I just find that when you can see it, it's very tempting to use it. So if it's out of your sight, it's out of your mind, and you won't remember. So when you're logging into your bank account, you don't actually see that money, so it's actually not there. So when you do need it, it will be there. The other thing that's important is if you do have to tap into that slush fund, top it up again, because unfortunately Murphy is alive and well, and you could get hit with something a couple of months later and have to dip back into it. And if there's not enough money, you're going to have to then go into credit. Invest the maximum you can afford into the tax-free savings policy with a company that allows you to nominate a beneficiary, and don't withdraw any money from this policy. As I said, unfortunately, most people that have a tax-free savings that have been sold either through media or however think that it is something that is a liquid investment they can save up and then they can take out. And you need to understand that for the purposes of using that product to its best, and to take advantage of all the bits and pieces that will work for you, you need to have it as a long-term investment product in your quiver. Pay off your short-term debt as soon as possible. I find this quite worrying in the younger generation, how many of my younger clients have got an awful amount of credit card debt, personal loans, revolving loans. It is terrifying. I don't know how these youngsters are ever going to get out of it without some kind of windfall or inheritance of some sort. And the scariest part, I think even more so, is that they don't really seem to care that they're so indebted. And I'm not sure how to resolve it, but I'm hoping that, you know, we can pass on to our children a better savings philosophy and better habits, so that they don't end up in this debt trap, because it's a never-ending pit. They can never get out. And I try and coach people on a regular basis in terms of debt control and debt consolidation and debt counseling, if you want to call it that. That's it's soul destroying, because you're paying off interest. That's it. To try and pay off capital is practically impossible. So pay them off and close them. Have one credit card that you use, but use it in a positive balance, please, guys. Always preserve your pension or provident fund money when you resign or get retrenched. I think that's also critical, because that money has been allocated for retirement. Try and keep it in that pot for retirement purposes. Build up 2 pots of money for when you retire. You have your voluntary, your tax-free savings, your unit trust, your matured endowments, all of those products that can give you a little bit of leeway in terms of when you retire, and then have your compulsory pot of money, which would be your pension funds, your provident funds, and your retirement annuity policies. That way, when you get to retirement, you actually have room to move. You're not forced to draw maximums out of your living annuity because you actually have nothing else to live on, because the money will unfortunately won't last. Diversify your investment portfolio. Shwed sort of concentrated on that a little bit on the previous presentation, but that basically means diversify between asset classes, local and offshore. The one I didn't add in there, which I should have, is between the investment manager types, in terms of, are they value managers? Just diversify. Don't have all your eggs in one basket. And remember, look at your investment portfolio as a total. Your property, I mean, if you've got second properties and rental properties, that is part of your investment portfolio. You need to look at the big picture and see how much of your portfolio is allocated in property. Are you overweight? Should you maybe not rather invest, try and diversify that portfolio somehow? Understand the fees that you are paying on your investment products, the platform fee or the insurance house fee, shareholders fee, management fees. They call them all sorts of different things. Investment manager fees, those are the guys that are actually running the money, the Alan Graham Balanced Fund Manager, the Coronation Strategic Income Fund Manager. Each portfolio has an investment manager fee. Discretionary fund management fees. We're going to have a special session or a separate session with Fund House, who's the company that I use to assist us to make sure that we understand and know why we're using a DFM manager, because the choice is just vast out there in terms of how many places you can invest money, where to invest money. I've had a number of clients over my 21 years, but in the last few as well, that have invested in companies that have gone under, that have gone into liquidation. They've lost massive amounts of money, and it's that kind of risk. Luckily it wasn't anything that I advised. Thank goodness. thank goodness for small mercies. But those things are very tempting. The other thing I can say here is, if it sounds too good to be true, it usually is. And the Ponzi schemes and those scamsters are still out there. So please be careful when it comes to making choices in terms of investments. Markets are volatile. Don't make emotional decisions. Try and just take a breath, sleep on it, I suppose, is the best advice I can give before you make a rash decision. Advisor fees, obviously, that's also very important. I think fees are going to play a bigger role going forward, and I think hopefully that everybody will come to the party to make sure that the fees are brought in line with international norms, because at the end of the day, every single percentage point that you pay in fees erodes your growth over the long term. And the last thing I want to say, to leave with you, is make sure that your beneficiaries are updated, especially on your pension and your provident fund and your retirement annuity money, because it is critical. You don't want your beneficiaries and your spouse and your kids to have to wait for money to pay out because of something as simple as you didn't fill in a form. I know most people hate admin, but it's one of the things that I think you need to make a priority. Do it once a year. Set a date in your diary and do a repeat just to check. Make sure that your advisor, whether it be me or another advisor, gets notification and CC them, copy them on whatever it is that you're sending through to HR, so that you've at least got confirmation of the last one that was submitted. And most importantly, you've got to have a valid will. And the emphasis is on valid. A lot of people have a will, they don't realize that it's not valid. It's not signed correctly, it's not dated. All sorts of things, unfortunately, could go wrong when it comes to will drafting, and people hate talking about death. I think it's probably the thing I've noticed the most in all the years I've been doing this, is that unfortunately death is reality, and I think what we need to do is just tackle it, discuss it, get it on paper, and then you don't have to worry about it. Unless something changes, then you need to review it. But other than that, I try and advise you or my clients and you, to do things as generic as possible, so it's not the end of the world if you haven't changed it, unless something dramatic has changed in your life, like a divorce or something like that. So guys, thank you very much. That's me. That's everything I have to say. I hope I didn't bore you too much. I hope I gave you enough information to make you think a little bit. You have our contact details. You know where to get hold of us. If there's anything or any queries or anything you need to know more about, please don't hesitate. Give me a call, drop me an email, and we'll be in touch. We're not going to have Q&A now. I think it'll be a waste. So, and the next session that we're going to do, it's going to be regarding the post-retirement products. So we're going to have a service provider that has come onto the market that offers a hybrid of both living annuity and linked life annuity. So living annuity and life annuity. And obviously the life annuity on its own as well. And then we're going to have Schwab from Alan Gray doing how the living annuity works and the comparison between the two, just so that you can get more specific information with the post-retirement products on their own. I think, though, that one will probably be a pre-recorded session that we will email out to you guys, rather than you having to log in and spend time during office hours listening. So I hope you enjoyed it. Thanks very much for everything. and see you again soon. Bye.